Hi. That's going to do it. Thank you. Can everyone hear me?
Yes.
Great. Good afternoon, everyone. Welcome to Piazzi's annual Women in Fixed Income Conference. I'm so thrilled that we could do the event in hybrid form this year, and it's such a pleasure. Yeah, it's such a pleasure to meet so many familiar faces, and I hope to make a lot of new connections, as I hope you will too. We wanted this event to be celebratory in a really warm and vibrant environment, as you can see. So we couldn't think of any better place to host versus, at Luminary. So this is the headquarters of Luminary. And Luminary was founded in 2018 by Kate Luzier, who's right here with us. And she founded the space to uplift, upskill, and empower women in all phases of their career. And you'll get a chance to hear more about it yourself when Kate joins later in one of the panels. And I think we have, besides a full room here today, we have over 500 registrants on Zoom. So that's fantastic. We'll also get an opportunity later to have a networking hour with female entrepreneurs who are catering the event. So I hope you will all stay and join us. As you can imagine, events like this cannot be put together without the hard work of many. We have a highly engaged board and committee members. And in particular, I want to thank Joyce Chang, Chair of Global Research at JP Morgan. Joyce is our 2014 Hall of Fame honoree. She's on our board, and she has been associated with the Women in Fixed Income event since its inception and is responsible for inviting a lot of our amazing speakers today. So thank you. I would also like to acknowledge Lauren Nauser, our Executive Director, and all the Luminary staff for their tireless efforts in putting this event together. And finally, I'm very grateful to all our sustaining members, Standard & Poor's, CreditSights, Fitch, and DBRS, as well as JP Morgan and BNP Paribas for sponsoring this event. So another round of applause for all our sponsors. Okay, so for those of you who are new to the Fixed Income Analyst Society, the organization was founded in 1975, so 48 years ago, to promote diverse views and thought leadership within the fixed income space. And we are known for our speaker series and networking events. We have a really exciting agenda for the remainder of the year, including our ESG conference that is going to take place in spring, and our Hall of Fame Gala that's going to take place in September. So please tune in for updates on these events on piazzi.org. The Women in Fixed Income event was started to bring a lot of female leaders and our male allies to discuss perspectives and outlooks about the global fixed income market. And so we're really excited to have all of you here today. And then in terms of the agenda today, over the course of the afternoon, we will have insightful conversations around how the New York Fed Reserve, things about financial systemic risk, and then on the macro and micro panels that are going to be moderated by Erin Lyons and Joyce Chan. We're going to talk about a number of different topics, including outlooks for the market, how we're thinking about actions by the central banks, recession risk, and all the good stuff. So it'll be a really insightful conversation. We are also excited to feature Girls Inc. That both Joyce and Kate are involved with, and learn about their work in promoting financial literacy, among other initiatives with girls. So just before we get started, a quick note for journalists that have joined or media that have joined us for today. If you are going to quote anyone directly, please clear it with the speakers. And now I'm excited to introduce our keynote, Anna Kovler. We're so thrilled to have you. Anna Kovler is the Director of the Financial Stability Policy Research Division at the Federal Reserve Bank of New York. Her policy work focuses on financial stability, including financial intermediation and systemic risk. Her research focuses on topics in corporate finance, including banking and venture capital, and she's widely published in numerous journals, including the Journal of Finance, Journal of Financial Economics, and Journal of Financial Intermediation. Anna received her Bachelor's of Arts in Economics from Princeton, an MBA from Harvard Business School, and her PhD in Business Economics from Harvard University. I hear that her unpublished research passion relates to why so few women go into economics. I was an economics major, but then kind of switched into finance. So Anna will kick off with a presentation, and then she will do a Q&A session with Ritika Gupta. Where's Ritika? There you go, Ritika. And Ritika is an on-air reporter and a producer from Bloomberg Television, who contributes to Bloomberg Radio, Bloomberg News, and Bloomberg.com. Ritika also works with Bloomberg's New Voices media training program that has been highly successful in promoting and amplifying female and underrepresented voices globally. And I've personally had the pleasure to be part of that program. So thank you, Anna and Ritika, for joining us. And without further ado, please welcome Anna Kovler.
Thanks very much, and I'm delighted to have the opportunity to speak to this group. I'm going to do my best not to fling this microphone off or step out of where folks who are watching in a hybrid environment are able to hear me. And you guys are kind enough to put up some slides because I was hearing as we were getting started that this was a bunch of nerds. So that I must be with my people here. And so it's great to be together with you guys. And let me just start with the standard Federal Reserve disclaimer that my remarks today are going to represent my own views and not those of the Federal Reserve. So great. I'm going to start on the slide previous to that on the second slide. And I'm going to talk today about some of the work that I've been doing thinking about fixed income, but I want to start by highlighting a little bit that there are a number of things about the economy that we can learn from understanding financial markets. So first, financial markets have information about financial conditions. So studying measures derived from various asset prices that are associated with output are a key part of what we want to understand to think about how financial markets incorporate and combine with the Federal Reserve policy to affect employment and prices. Second, I'm going to back and thank you. The global financial crisis showed us how important it is to understand and mitigate vulnerabilities that can build in the financial system and amplify shocks that are likely, we can't anticipate, but may hit the global economy. Thus, financial markets are going to offer us insights in financial stability, thinking about, for example, the way vulnerabilities might build up in terms of elevated asset prices, excessive borrowing, leverage in the financial sector, and the way funding and maturity risks might be building up. Moving to the next slide. Fixed income markets have long been an interest of mine, and I know that this audience shares my view that it's critically important to understand the dynamics of bond markets. The US is somewhat unique among advanced economies in the extent to which borrowing is funded through capital markets. There's more than $10 trillion of corporate bonds outstanding, and these bonds provide more than 2/3 of total debt funding to non-financial corporations in the US. And most of these US corporate bonds are owned by US residents, funding insurance and retirement for savers. Turning to the next slide. In this slide, you can see a reminder in graphical form of the challenges faced by bond markets in March of 2020. I guess anyone who's been employed in fixed income maybe doesn't need any such graphical reminder. But where we saw this unprecedented global shock presented by the need to respond to the COVID pandemic and the way in which investors were adjusting their portfolios. You can see in these two graphs on the top, the evolution of the deterioration in the bond market by risk type. Bonds that are rated AAA or AA are shown in red, A bonds in blue, BBB bonds in green. And in the top left is a graph of duration matched credit spreads, and the top right shows bid-ask spreads. In some sense, you don't need to know what any graph is going to look like here. These both rose dramatically in March for bonds of all risk types. Another way of thinking about dislocations in markets is to compare prices of the same cash flows in different markets. So again, we saw in March this dramatic movement in the CDS bond basis and the price to NAV basis for bond ETFs, both in investment grade markets, which is the green line, and in high yield bond markets, shown in blue. So turning to the next slide. In March of 2020, the Federal Reserve, working together with the US Treasury, responded to ensure that US companies would continue to be able to access capital markets to fund their businesses by establishing the primary and secondary market corporate credit facilities, known as the PM and SMCCF. I will tell this group that I begged my colleagues to name these with some vowels. These acronyms are perhaps some additional evidence that our expertise at the Federal Reserve is not in sales and marketing. We looked at the impact of these facilities in academic work I've done together with my colleagues at the New York Fed, published in an academic journal. And we find evidence for 4 key impacts of the interventions. First, we find that they reduce bond investors' risk premiums, meaning that the price investors are asking to compensate for risk fell, consistent with an improvement in the prospects for the US economy. Second, it looks like the facilities reduce the extent of indiscriminate asset sales by reducing the information sensitivity of bonds eligible for facilities, meaning restoring investment grade assets to the set of assets for which folks might not feel, maybe not folks in this room, but other folks might not feel they need to do a significant amount of credit research on. Third, we see that the facilities increase the willingness of broker-dealers to intermediate in bond markets. And finally, we found a direct impact of the bond purchases themselves on eligible securities, as well as from the presence of a backstop lending facility. I have all these charts with my extra papers. Turning to the next slide. We learned in March 2020, and before that in the global financial crisis, that corporate bond distress has a lot of facets, but is generally marked by a slowdown in primary market issuance, falling secondary market prices, the drying up of liquidity, and trading volumes can actually grow or shrink. And so recently we've begun publishing on the New York Fed's website one measure that we've developed in order to help better understand the functioning of these key markets. So the Corporate Bond Market Distress Index, or the CMDI, I don't know, it's a vowel, but we were never able to come up with something that was like a great word. But it's based on weekly data, which we share monthly, with the goal of understanding and summarizing aspects of bond market functioning. One thing that we're not trying to do in this index is aim to forecast or summarize prices. Turning to the next slide. A key innovation of this index is adding primary market measures to secondary market measures, because the information that you get from primary markets is not always the same as the information that you would see in secondary market trading. One example of that is shown on this graph, where you can see on the left axis, the blue line is the growth rate of the amount outstanding of corporate bonds, so issuance net of maturities, while the black line on the right axis shows something like the excess bond premium spread, so the spread in bonds after including controls for default risk. While these measures are generally correlated moving together through time, you can see that over the last couple of decades, they offer quite different information over time. Turning to the next slide. Another innovation of this index is to think about how to combine multiple measures. We call this approach a preponderance of measures approach because it relies on the intuition that periods when more individual metrics are in the tail of their corresponding distribution are going to be time periods when the market is more likely to be in overall distress. An advantage of this approach is that by using more measures optimally combined, will give you a resulting index that's less volatile and less vulnerable to distortion. Although, of course, the downside is that the varying weights mean it's much harder to tie movements in the index to any single of the measures. Thinking about the graphs I shared earlier about March 2020, another choice we made here is to focus quite narrowly on the corporate bond market itself, rather than on dislocations between related markets. And in some ways, an underpinning of this is we're really interested in understanding how debt capital markets are funding the US economy, rather than thinking about how secondary markets are moving. Turning to the next slide. Well, I don't have time in these remarks to go into extensive detail on how the CMDI is constructed. I've listed on this slide some of the ingredients. We make use of several measures of quantity, looking at volumes traded between dealers and customers, making use of trace data. We also consider several variants of standard measures of liquidity designed to capture secondary market trading costs. While the index isn't engineered to focus on prices, prices are very informative about market functioning. And so we're going to include in the measures mean, volatility, and dispersion measures, both of raw credit spreads, those that trade, as well as thinking about the prices of bonds that are only quoted, because there's also information to be found in which bonds are trading. And then we're also going to think about raw spreads and those that are adjusted for changes in credit risk. And in part, the philosophy here is that a functioning market, prices are going to change when the quantity of risk increases in the economy or in fundamentals. A well-functioning market, prices are going to move to capture those changes. So you can see the first 5 categories all arise from secondary market data, but then we're also going to combine this, as I said, with measures of price in quantity in primary markets, where we're going to look at issuance and spreads. So turning to the next slide. Now we get into the nerdy. No. In order to combine these measures, we standardize them using historical data to calculate a cumulative distribution function, or a CDF, and then we scale them so that high indicates more distress. We reduce dimensionality by grouping measures that capture similar facets of market functioning. So I went through the sort of bunch of things that look at different ways to think about bid-ask spreads or trading costs. Those are the type of things we'd be grouping together because they're all capturing one. There's sort of tons of measures that people have written papers on, but they're all trying to get at that same core aspect of market functioning. I'm going to show you on the next slide what the resulting index looks like. But the other thing we're going to do is evaluate the similarity, looking at pairwise correlations between these different facets of market functioning. At times of distress, many measures are higher. So you can see on this graph here, each color represents one of these sort of 7 facets of market functioning. And in these distress times, many of the measures are higher, but it's not necessarily always the same measures that are going to signal more severe distress episodes. But one common feature of periods of this extreme distress that we've seen thus far is going to be the increase in default adjusted spreads, or the excess bond premium, the types of measures that are capturing the risk investors ask the compensation investors ask to be compensated for risk. And that's shown here in yellow. You can see it taking up a kind of share of the graph during the financial crisis and again in the pandemic. So turning to the next slide. The end result is the CMDI, which is shown here in blue over the historical time series. The index is scaled from 0 to 1, but we also think it's informative to look at the percentile of the pre-2020 historical distribution. And that's core, that's giving us this notion that we want to have a sense for how the level of the market or its dislocation compares to the historical experience. The index peaked in the financial crisis, and you can also see one of the notable features of the March 2020 incident is the unprecedented speed in the increase of this index. Notably, we also find that this index predicts real activity a year ahead, a relationship that exists over and above the information that arises from looking at bond spreads or the excess bond premium alone. Turning to the next slide. Zooming in on the recent data through the end of January, you can see the blue line here in the middle represents the CMDI at the market level. We spent a lot more time thinking about this overall market index, but we also produce the same information for investment grade bonds, which is shown in the black line on the top, and high yield bonds shown in green. While the high yield index was below its historical median at the end of January, you can see the investment grade index had reached very high levels. Consistent with the slowdown, it's an index, remember, that includes primary market measures, and that's consistent with the slowdown that we have seen in primary market issuance. And again, something you have to think about in the context of the very robust issuance we saw in these markets in the past few years. Turning to the next slide. While we have relatively few tightening cycles to look at, bond market functioning is related to the stance of monetary policy. So what we've done here is try to overlay with a time setting at 0, the current policy rate cycle, that's the Fed fund target in the current and the yellowish orange line, as well as the previous recent cycle from 2015. This is finished before the most recent FOMC meeting last week. What you can see from this is that the CMDI peak level thus far has been similar to the peak level reached in 2015, although of course the tightening that we have seen more recently is much, again, more dramatic. We only have that sort of short rise of 2015. Next slide, please. So in closing, I hope I've told you a little bit about the CMDI, which you could read more about. We have an academic paper that goes through all the mechanics of it, and you can find it on the New York Fed website. It summarizes in a single measure how capital markets are functioning to fund investment. And we see that the recent deterioration in the CMDI is generally consistent with past tightening cycles. And I would emphasize the overall market index is close to its historical median. It's worth taking a step back here, I think, to think about what it is we learn from indexes. Having a single number to talk about makes life easier. It offers a single measure for what's going on that reporters and policymakers can understand, and they say that's the number. But of course, interpreting the meaning of that number and how it changes over time really requires an understanding of the subcomponents. Maybe I'll leave you with the thought, you could build an index of the various measures we use to think about women in finance and what that might look like. If you started with some readily available statistics, women are less than 16% of mutual fund managers and about 23% of financial services C-suite executives. When you think about the pipeline, of course, you could build a career in finance from disciplines other than economics, but only 30% of economics majors are women. And they are being educated by tenured economics professors who are approximately 15% women. If I built that into an index, optimally combined it, we can all do in our heads that index would likely be at a high level relative to the historical experience. And actually, I mean, back in the bond market context, I think it's interesting to think, what if we had built this index before the global financial crisis? Anything you're comparing to the historical distribution has to have the context of just how good or bad things have been historically. And so then the question, we have to ask is, what direction is that index moving? Have we been moving sideways or up? And looking beyond gender, how are other represented groups faring? Thank you. place for us to sit, or is it better over here? I don't know what the pillars are coming out for you guys.
You're good with that.
All right, well, good afternoon, everyone. First of all, thank you very much, Anna, for that very insightful presentation about your work at the New York Fed, financial stability and the vulnerabilities building up in the financial system. And we will delve into all of that further, but first off, today is about celebrating women in the industry. So I want to talk about your background and how you got to where you are, because you started off as a fixed income investor on the buy side. So I'm interested in your motivation to switching to the Fed and focusing in on financial stability.
Great, thank you. I guess as you guys have heard, I'm prestigiously educated. After I got my MBA, I went to work on the buy side doing distressed and for an early high yield bond CDO fund. And I used to spend a lot of time at work saying to my boss, you know, what is going on here? Why are we making this money? You know, is it sort of category of things? And Fred Eckert, who I worked for at the time, just looked at me and he was like, "Yeah, I really don't care. Like I don't want to talk about this anymore." And I got the feeling that my day job was not going to be about investigating those patterns. And so that's really what sent me back to graduate school to get my PhD in economics, to sort of study the sort of structural and theoretical phenomenons that I was seeing as an investor.
And from your time as an investor and on the buy side, what are some of the key lessons that you're able to use within your role at the Fed today?
I think one of the lessons that I learned investing is to think about, who's making money on this and how and when. So that could be in a creditors committee to think about, what price people were in at, to think about what they might agree to. And I think about that when I'm studying phenomenon in financial markets and how financial stability vulnerabilities might build up. So how are people being compensated for the risks that they're taking? Are those risks that would occur at the firm level or the portfolio level, where often you wouldn't be internalizing the risks that are building to the system as a whole? And so, always kind of trying to keep my eye on how are people here making money, and then what risks then are not going to be priced.
And talking then, you talked in your presentation a lot about the vulnerabilities that are building up in the financial system, but I want to focus specifically on the non-bank sector and how you assess the risks outside traditional banking, particularly as we are at a time where non-banks are playing an increasingly bigger role in the financial system.
I think when we think about financial stability and the risks that emerge, obviously after the global financial crisis and the passage of the Dodd-Frank Act, there's been the sort of regime of regulation and supervision has been greatly enhanced for a set of entities. And then we have seen an increasing share of intermediation move out of that system. So in some ways, the vulnerabilities that we think of building up are the same regardless of where they are. So we might think about our asset prices very high relative to fundamentals. Our businesses or households who are making these, borrowing this money, are they borrowing too much? And how levered are the intermediaries that are making these loans, because each of these things make them more vulnerable to shocks as they arise. Another type of things that I think is particularly relevant for the non-bank financial institutions is thinking about risks like a liquidity mismatch and a maturity mismatch. So we've seen recent rule proposals out from the SEC to think about open-end funds, and that really responds to the type of non-bank intermediation where funds are providing more liquidity than the underlying assets that they're invested in. And so in that sense, that's sort of the classic sort of set of run risk that arises and banks in the 1800s, but non-banks don't have the same type of access to lender of last resort, nor do we have the depth of information that we do about some of the regulated industries. And so I think with non-banks, one of the things we're trying very actively to think about is how do we make sure that we have enough information to understand how these risks are maybe building up in the economy. But one thing I would offer up is, the US has traditionally had, you think about corporate bonds, that's the kind of classic type of lending which is done outside of the banking sector. And I think that's also led to, the US has some of the deepest financial markets, which are able to fund, US and global growth. And so I think that's also a strength, of the US economy as well.
Yeah, and I think a lot about, the policy questions, therefore, with the institutional differences between the lenders and the implications for monetary policy with that. Would you say then that the non-banking is becoming a source of systemic risk?
I think that one of the things I think about non-banks is it's very hard when we group them all together. And so I really try to encourage people to think about those. I'm everywhere. I think it's really important to think about the type of non-bank and the structure of the non-bank. So, one thing that we've tried to follow is there's been an increase in private lending, for example. And so is that being done in funds? What does the liquidity of those funds look like? Is that locked up liquidity consistent, with the fact that it's investing in a set of loans? And so I think, that's sort of one way you might think about each of the non-banks a little bit differently. And I think we can be less concerned about the systemic risk of any particular type of intermediary when we think about does it have a match between the liquidity of its assets and its funding? How levered is that intermediary? So we haven't, at least thus far, seen as much of that private lending being done through levered entities, but those are the types of things we want to understand when thinking about non-banks.
And in terms of regulation, what would you say are the missing gaps?
I think that, as an economist, I always want more information. So it's hard to say what the gaps are when, unlike other countries, I guess I'm speaking on my own behalf here, I'll emphasize again, but, other countries have credit registries where you would have a mapping of all the lending that's being done in the US economy. So when we sort of set out to understand, where the sort of transformation that helps grow an economy is being done, we don't even start with some of the information to understand the risks. And so I think that's, an important area to think about.
And looking forward now as well, as we talk about the bond market and how it's functioning as interest rates are rising. So how do you see financial markets transforming as we move away from the zero lower bound?
So I think in some ways there's an opportunity for this to result in a reduction in financial stability risk to the extent that some of the reach for yield behavior that we saw after, decades of very low rates may subside. Investors with some sort of nominal return mandate have really struggled to reach the returns that they may need. And, so in that way, you might expect some asset allocation, towards lower risk assets. I think one of the things that I worry about conversely is that when you think about the type of data that runs a lot of risk management models, it's not, we don't have a lot of data from the last 20 years that is informed by time periods that look like what we're in today. So the COVID data is very unusual, of course, but even when thinking about a model that was incorporating inflation, if you wanted to run that model 5 years ago, there wouldn't be really much in there unless you were doing it on data from other countries. And so thinking about whether people really understand their risk models and ways in and how to think about how the environment we're in today is different from the historical data that inform those models, I think is critically important.
Well, I think we're running on time now, so I think we could talk about that for a lot longer, but thank you very much, Anna. Anna Cogner, the New York Fed there.
Thank you.
Thank you so much, Anna and Patricia. It's great to hear your discussions. As a former strategist, I envy your charts and all your data series, so thanks for sharing that with us. Now we're going to talk about the macro outlook with some of our experts. So I invite the panel to come on up. I'm Erin Lyons from Credit Sites, a board member of FIASI, and thanks everyone for joining us today. I'm excited to talk macro with our experts. We have Rebecca Patterson, who is the former Chief Investment Strategist at Bridgewater. We have Dana Peterson, who is the Chief Economist and Center Leader for Economy, Strategy, and Finance at the Conference Board. And then Megan Robson, who is the Head of U.S. Credit Strategy from BNP. So really knowledgeable group, and I'm excited to dig in and hear the views. So I'm going to start with, I think everyone's happy that we're past 2022. Anyone in the fixed income markets know that it was a really, really tough year. A lot of that toughness was driven by inflation. So I want to dive right into that topic and start with Dana. Last year it was one of the main drivers of concern and action last year. How should we be thinking about inflation at this point?
Well, I think we should still be concerned about, inflation because we're not out of the woods yet. When you look at the composition of what's driving inflation right now, it's three things. Number one, it's food prices, which are determined globally, and the Fed doesn't really have much control over that. That's a supply side driver. Another aspect is what's been being called core PCE or core inflation, which is essentially services inflation without housing, food, or energy, right? And those prices are continuing to rise and be sticky because there's a lot of demand for services, especially in-person services, things you have to physically go to, like hotels, restaurants, travel, airlines, that sort of thing. And in many of those sectors, you have severe labor shortages. So you have elevated wages that are being fed through to consumer prices. And then the third element that's driving inflation right now are rents. And rents are a reflection of what's already happened to home price valuations. Now we know home price valuations rose very aggressively during the pandemic because interest rates were low. People working remotely, millennials decided now's a good time to buy a house, right? And that's reversing. But the thing is that it affects rents with a lag, anywhere from 12 to 18 months. So those are the three things that are driving inflation. Certainly, as the Fed has said, the home price valuations feeding through to rents is in the pipeline, but it's going to be several more months before that happens. And certainly when we think about food prices, again, that's being driven very much by external factors like the war in Ukraine, also bird flu, droughts, flooding, that sort of thing. And then the final piece, which are services. That's really going to be up to the consumer. Do consumers want to continue to spend? So as long as the Fed does not feel confident that inflation is coming off quickly enough, the Fed is going to be raising interest rates. And we think 2 more times, 25 basis points in March and May.
Are we starting to see any relief on these main three categories? You mentioned rent takes a while to roll off, but is this here longer than many people expect?
Well, I mean, what we have seen relief is definitely on energy prices. I'm not a believer that China reopening will cause this dramatic surge in global demand for oil for a variety of reasons. I won't get into that. You can call me and talk later. So, we may get a break from that and continue to see energy prices not be as intense. Certainly goods prices are falling or slowing because consumers have moved away from primarily buying goods to services. Now, so far, I haven't really seen much improvement on the three fronts that I mentioned, but we're going to get a CPI report next week. We'll see where we're headed. But I still think that there may be a couple more months of, a few more months of very sticky inflation before we really start to see inflation trend back towards 2%. And we may not get to 2% until the end of next year.
And just another question in light of what came out over the past week, what should we be making of the unemployment picture and the unemployment rate?
Yes, well, I mean, the interesting thing is that we've been saying at the conference board, we're one of the folks who came out early with there could be a recession in the US. If not, the end of last year, then early this year, so kind of now. But you would not see material deterioration in the labor market, meaning, we could have roughly 900,000 to 1 million jobs lost. I would not want to be one of those people, but still in all of the unemployment rate could rise to 4.5%. That is full employment. So we're below the rate of the level of full employment. And the big reason why this time is different, I know people always say that, but this really is different, is labor shortages. We've never had labor shortages like this. Have there been labor shortages in the past in America, in the US? Of course, yes. We had them in the 1800s. We solved that with immigration, right? Well, before that, we solved it with slavery, but let's not go there. But just being truthful. And then certainly during World War II, you had labor shortages, but we women, stepped in and worked. I mean, we were kicked out of the labor market after the war, and we came back during the 70s. But this time is different because you have millions upon millions of baby boomers all exiting the labor market right around the same time. And many of them are not going to come back. Meanwhile, our immigration policies are very strict. And also you have many people who are outside of the labor market and staying out of the labor market because they have to care for children or elders, right? So you have all these things, but the biggest issue are retirements of the baby boomers causing labor shortages. So that means there are many businesses that are holding on to workers. We just published our CEO Confidence Index this morning at 6 a.m. And in it, we asked CEOs of big Fortune 500 companies, what are you doing about labor? Most of them are not doing anything. They're going to hold their workforces static. And also many of them are still looking to hire. Where's the hiring happening? In those in-person services and those businesses, those industries that never fully recovered from all the layoffs during the pandemic. Hotels and restaurants, entertainment, healthcare, right? So many of those sectors are still hiring. And so that's how we're having this odd dynamic in the labor market, even though we're talking about economic slowdown.
Thanks for all the information. But let's pivot to Rebecca. So hearing that and knowing what happened last year, how did the macro backdrop impact your investment strategies?
Sure. So first of all, thank you so much for having me here today. It's great to be with all of you. It says I'm on. You're good. It's on. Hello. Okay. So first of all, I love that you just talked about retirement. I published a piece in the Financial Times yesterday on this exact topic, demographic decline, and how it has always been the slow-moving, boring structural issue, but right now it's become a timely, urgent, cyclical issue for exactly what you're talking about. So the structural and the cyclical have collided. But getting back to your question, so last year, for exactly the points you made, the rents being a very slow-moving inflationary force, and then labor, we believed that inflation was not going to be transitory, that it was going to be higher for longer, stickier for longer, and that the Fed would have to respond, and that we would get more aggressive than expected tightening. And so we positioned accordingly. Basically, if you get that sharp of a rise in nominal and real rates, it tends to be a drag on all assets. And that's exactly what happened last year. There was nowhere to hide. Cash was the thing you wanted to be in.
With 9% inflation.
Yeah, so your real return there even wasn't too hot. Now, when we fast forward to this year, it is so interesting because on one hand, we've had the most aggressive tightening cycle from the Fed in decades. And if you use the San Francisco's data for their proxy measure of the Fed funds, which incorporates the balance sheet runoff, it would say that already now we're at 6% Fed funds, and we're still looking for more tightening ahead. So this is the sort of borrowing cost we haven't seen in decades and decades. So that's feeding through the economy. And you could say, all right, given that, it is reasonable to expect a slowdown and most likely a recession. But then you get to your points, right? The consumer has run down their excess savings. Remember, they ended up stronger after the pandemic than before the pandemic because of the extraordinary fiscal and monetary stimulus that they benefited from. So they came out wealthier, they were able to spend, they did spend, that was part of the inflation surge. Now they're running down the savings, but they're still spending. It's slowing, but they're still spending because they're tapping those good old credit cards. And yes, the average cost of credit cards has gotten quite high, punitive, but delinquencies are still relatively low. The spending is continuing. So one question I'm asking is, when does the consumer start to really retrench? With disinflation, real incomes are getting a measure of support. And so that, and they have jobs. So the spending might continue longer than I think what a lot of folks expected, maybe late last year. So that's one question. When does the consumer roll over? And the second related question is, to your point, on the job market. Do companies, because of higher borrowing costs, because of a moderation in growth that happens as the rate hikes feed through, does that lead companies to pull back? And if people lose their jobs, they slow their spending because they don't have the incomes. If they slow spendings, companies pull back more and you have kind of a self-reinforcing mechanism. We're not seeing it yet, except for the tech sector, but that's 2% of private sector jobs. It gets lots of headlines, but it doesn't move the needle for the broader economy. So we need to see companies pulling back, not happening yet in mass. We need to see the consumer pulling back, not happening yet. I still think we're going to see it. The question to me is timing and degree, but not direction. So I do think we're likely to get a recession some point later this year because the Fed needs to get inflation back to target. And to go final point on investments. So the one mispricing, there's very little this right now that I pound my fist on the table because it's a highly uncertain market. I think we all have to be super humble. But the one area where I'll stick my neck out is the fact that the market's discounting easing in the second half of this year. So if we have a recession, the Fed eases, you could say, yeah, that's reasonable. But will inflation be back to or below 2% that quickly? Given that we're still looking at wages, depending on how you measure them, running at 4 to 6%. Atlanta Fed wage tracker today, 6.1%. Other measures, maybe a little bit more leading, still over 4%. So wage have to come down a lot. Are they going to do that without a rise in the unemployment rate? And are we going to get that happening until the consumer stops, companies stop? So a lot of things have to go right to get inflation back down to 2% and allow the Fed to ease that quickly. It's possible, but I think it's highly unlikely. So to me, that is the big mispricing. The markets are discounting that. So that means support for equities, support for credit is coming from an expected easing that I don't think is going to happen. Therefore, I would expect to see more headwinds this year for cyclical sectors like equities and credit. Maybe not the same as last year's magnitude, but it's not going to be January over and over again.
Which is a good segue to Megan's view on the market. I know you've done a lot of work on corporate health. And one thing I was just thinking as Rebecca was speaking is, even if inflation comes down, we're still at these elevated prices, right? It's run so rampant. I mean, if consumers are drawing down their balances to be able to fund these purchases, what happens at these, even if it slows the rise, these prices are still high. Like, do companies run into an issue with margins, input costs in that scenario?
Thanks. So we have a pretty cautious view heading into 2023 for corporate credit, and it's really based on our thesis that we think credit fundamentals have to deteriorate as the Fed achieves their goal of bringing down inflation. I think a few of the bottom-up metrics that we're already seeing some weakness in, so corporate margins in third quarter, we saw corporate margins roll over for the first time since COVID. We're pretty early in fourth quarter earnings season, but we have seen more margin compression happen. So in Europe, for example, some of the more cyclical sectors have kept prices constant, but we've seen volumes decline pretty substantially. So I think that's a trend we will see continue for the rest of the year. So earnings coming down, we think guidance will continue to be lower. I think the metric I'm more worried about actually is interest coverage. So for higher quality investment grade names, I think interest coverage will be okay, but in markets like the leveraged loans where most of their capital structure is based on floating rate costs, assuming the Fed stays higher for longer this year, a lot of issuers have almost double the interest expense that's gonna start filtering through. So that's the sector we're sort of looking for weakness to start playing out first in terms of downgrades and eventually a pickup in defaults later this year.
And just keeping with some of the things Rebecca mentioned, the market has been on this train so far this year where everything looks good, everything's awesome. Watch the Lego movie. What do you think investors are thinking at this point? Why are they ignoring what seem to be some pretty obvious signs?
I think it's two things. I think one, there's legitimately a higher probability of a soft landing after end of last year, we had 3 softer inflation prints. I think that is good news. And I think the path is very narrow to a soft landing, but you have to recognize that that has increased. So I think there is some rationalization around that. But I think the second thing is really just this really strong technical where there's still a lot of cash in the system. And I think from our end, we probably underestimated the amount of liquidity still out there that wants to invest in yield and lock in rates. So for investment grade, for example, people haven't seen yields like this in a long time and are happy to lock in rates. I think insurance companies that have liabilities that they want to match. And so demand is very strong and we haven't really seen a pickup in supply yet. So I think those 2 factors have primarily driven things.
So let's turn to Europe for a little bit. I know in our prep call, we said we need to think outside of the US a little bit and pay attention to what's happening elsewhere. Dana, I'll touch on Europe. What are you seeing there? Is there real risk in the European Union and the policies there? Or do you think the concern around Europe is inflated?
I'm actually more constructive on Europe now than I was over the summer. Because certainly we were looking at the dynamics there. You have the war in Ukraine, it's ongoing, and then it gets ramped up to Europe, Western Europe basically saying we're not going to buy Russian natural gas. And so what does Russia do? Well, in response to the sanctions and that announcement, they said, well, fine, we'll just cut you off. And so we said, that looks like a recession. And certainly you did see a cost of living crisis erupt during the winter, during the fall, but some good things happened where there's a lot of rationing, which is difficult on the consumer and on businesses, but that helped to build up inventories of natural gas. Also, many governments were supplementing households and businesses for the higher cost for natural gas. Also, many economies. Oh, sorry. Also, I'm having my sorry. That's okay. Also, many economies were able to source natural gas from other places, such as the United States and from MENA regions. So all of that, and then also they've had a pretty mild fall and now winter. So all of that suggests that maybe things won't be as bad as expected. Like we forecasted a recession in the Euro area, so including many economies, plus the UK for the 4th quarter of last year and for this quarter. Now, we do have some preliminary data. Germany and the UK were weak and a couple of other economies saw some negative trends, but then you had some economies like Ireland that were just good or off the charts good in terms of Ireland itself, but we still think there's gonna be some weakness in the 1st quarter, but that's still a shallow, even that's still pretty mild, and we may not even have a technical recession in Europe. But I still have concerns with respect to the war in Ukraine. Russia is thinking about another big offensive on the anniversary of the invasion. And also just last week, there were caps placed on diesel, Russian diesel. So how is Russia going to respond to that in addition to this offensive? President Zelensky is out across Europe and the US looking for more support in terms of weaponry. What does all this mean? And let's not also forget that in a few months, a few weeks, the agreement that was brokered by Turkey to move Ukrainian grain to help export it and get past, all the ships and the mines, that needs to be re-upped, right? And unfortunately, Turkey suffered a horrible event with 2 earthquakes that killed thousands of people. And also, so we're not sure like if that's going to kind of distract, right? So you could have another round of worsening of the war, which would certainly worsen the humanitarian crisis, and also the cost of rebuilding Ukraine. But you could also have another round of severe disruptions in supply chains, in grains, metals, rare earths and rare gases, which are used for building semiconductors, which go in everything, and also batteries, which we're using for this great energy transition. So while I'm more optimistic that we may not have this horrible growth, prospect for Europe, and indeed may even skirt a technical recession. And I'm saying that because they don't have a recession dating body like we do in the US. We have the NBER. They don't have that, so just 2 negative GDP points. We may not have that, but there's still a lot of uncertainty around the war, and I think investors cannot ignore that.
So Megan, I'll turn to you, and while it's not your domain, but if you could speak for your colleagues, what is your view for the European credit markets and the outlook there?
Yeah, so for European credit, we see duration risk or the risk of rates going higher as being more elevated in Europe. So I think we're still cautious on adding longer duration on the European side. And part of that's, like if you look at Germany inflation data, there's just upside risks there, and Europe's a lot earlier in the hiking cycle compared to the US. And then also on high yield, we're more cautious on European high yield versus US. The maturity wall of European high yield is much more near-term dated relative to the US. So as issuers face refinancing risks, we see that as a bigger risk for Europe, whereas US high yield at least is still has a little bit of runway.
And to put you on the spot, do you prefer US IG or Euro IG?
I think it's pretty even. We like the fundamentals in both. I think Europe was a lot cheaper, but now has compressed a lot. So I think we're pretty we don't have a strong view either way there.
Thanks. And Rebecca, I know you have experience in international markets. What out there is your biggest risk and opportunity as it comes to the global stage?
So we haven't mentioned China much yet, briefly, and I think it's important to go there right now, especially, the reopening of China faster than I think most people expected certainly is a positive catalyst for global growth. And I guess I have, on the bright side, I'm going to do a horrible economist two-handed thing here. On the bright side, you are seeing tourism pick up, you're seeing some spending pick up, you are seeing a normalization. And the latest PMI sentiment surveys suggest that at least in the short term, there's momentum. I'd say the other positive is that the government, including Xi Jinping, have been very explicit that they want the consumer stronger and they want infrastructure stronger. So they're spending. There's going to be more fiscal easing to come. So that's the good news. What makes me cautious, a few things. One is that I think a lot of good news is getting priced in very quickly. If you look at how the markets have behaved since the reopening rumors and then confirmation, everything from European stocks that are highly leveraged to China, to the Thai baht, to the Chilean peso, to copper prices, to iron ore prices have had big run-ups. In fact, just in the last week or so, you've started to see a bit of profit taking. Also, if you look at economic activity surprise indices, I'm giving Joyce a hat tilt here. JP Morgan built the first one, I believe. Now that a lot of banks have them, but they are useful to understand our data outperforming or underperforming expectations. If you look at China and now Europe, you've seen big run-ups. So positive surprises on a consistent basis for the last month or so. And what often happens is once things surprise enough, the economists say, oh, my forecasts aren't right. I need to revise up my forecast. But that takes up the bar to get further positive surprises, and markets react to what's not priced in. So if you have a higher bar, there's a greater risk that then the market is disappointed by the future economic releases, if you get my drift. So I do worry about good news being priced in. I also worry that the Chinese consumer is not the American consumer. We had these incredible fiscal transfers. So our revenge spending was on steroids. China has a lot of savings, but they also have much lower consumer confidence. They didn't get the fiscal transfer, so it's not clear to me how big a consumption wave will get. And then final comment would be that when we think about the government, I was shocked last year they didn't do more, right? Given what was happening with their economy, why didn't we get red envelopes with digital renminbi going out around the country? It didn't happen in size, and they could have, they didn't. They're looking at quality medium-term growth. So to me, it's a two-way risk, but how much of a rebound will we see? Will it beat expectations? If it does, great news for the global economy, great news for risk appetite, and at the margin, maybe a positive inflation impulse that could affect the Fed's thinking, but I'm kind of with you. I don't know how big it'll be, but at the margin, probably directionally inflationary.
So Megan, you have a lot of client contact. How would you characterize the market's positioning right now in credit markets, and also how they're thinking about the Fed? I guess Dana and Rebecca highlighted that the market's kind of missing something, but what are you hearing from clients and what are you seeing?
Yeah, so I think maybe stepping back on positioning from second half of last year, summer of last year, our positioning indicator showed max short. Basically, across our entire time series, investors were extremely short in July of 2022. That was when we were getting the higher surprise inflation prints, the jumbo rate hikes. Fast forward into the end of last year, when inflation started to sort of suggest that it had turned a corner, we were past the quote unquote peak hawkishness, investors started to add to risk. So in January, that has very much accelerated, and now our positioning indicator would say investors are modestly long, actually, so that they're actually long for the first time since 2021 in the credit markets. I think that sets the market up. Last year, it was very hard for credit spreads to widen because the market was so short. So there wasn't a marginal seller out there. And I think now it's much more balanced. I think it does set up the market for potentially being more vulnerable to a downside surprise, given that positioning has gotten a lot longer. And as that positioning has changed, we've also seen valuations compress a lot. So lower quality, for example, triple Cs have rallied a lot this month, and I think the implication there is investors should use the strength to position for decompression ahead, to position for dispersion, as we think fundamentals are gonna pick up. But in terms of investors' mindsets, I think there is a bifurcation. I think IG investors, it's still no worries. I think it's, IG has great carry, and the starting point for fundamentals is a lot better. I think in the leveraged finance space, there is more recognition that fundamentals could deteriorate, and investors don't necessarily like valuations here, but there's just so much cash that they feel like they have to participate. I think the penalty for being short and getting the timing wrong is just too high. So I think investors just have to position around in different sectors and different quality, and they can't necessarily sit on the sidelines.
So Rebecca, where do you think the opportunities are in this market? And how would you balance kind of the macro backdrop? And so I'll ask two questions actually. Where do you think the opportunities are, and which kind of macro risks do you think everyone should be paying more attention to?
So I learned years ago from a great mentor to always think in terms of probabilities and scenarios. The world is not black and white, and especially right now, it doesn't feel very black and white, lots of shades of gray. So when I think about what could happen this year, the market is discounting a soft landing, immaculate disinflation that gets us to 2% inflation quickly and allows the Fed to ease without a major hit to equity earnings growth. I mean, that would be amazing. But to get the wage disinflation, the rent disinflation, without a material rise in the unemployment rate, without consumers pulling back, possible, certainly, but I would say probably closer like 30%, maybe 40, but probably closer to 30. So that leaves me 60, 70% that this is going to be a tougher year than people are giving it credit for. Again, I always want to look outside. I want to look globally. I think a lot of US investors can tend to be a bit parochial. in their thinking and just look at US fundamentals, US data, obviously what happens in China affects us. What happens in Europe affects us. What happens in Turkey and Syria will affect us. So when I think about what could keep inflation a little higher than longer, and with the Fed cut rates, if inflation's above 2%, I don't think so. I mean, I think the Fed officials are desperately trying to tell us they're not going to do that. And the market is so conditioned from the last decades to expect a Fed put that they're just not listening yet. So if rates are higher for longer, doesn't mean we don't get easing, but they're higher for longer than is priced in. And we have to see a bit of moderation in the labor market to get wages down. I think this is going to be a year where you get bumpy ranges that are going to be hugely frustrating for people to try to trade in time. And so you're going to be looking at stocks and bonds, depending on the month and where the data is landing, just kind of bouncing around. And that's not a fun place to be an investor, frankly. I actually think cash is not a bad place to have a little exposure. When you can finally get nominal rates, you can get daily liquid risk-free asset for almost 5%. Yay. I like, huh? I just talked to JP Morgan last week. And, thank you.
Marcus is at 3.5%.
Yes, I'm very happy with my bank. But I think you have to keep an eye on the short-term data. You have to be a bit tactical. I would be fading the dollar weakness, maybe not today, but averaging into a longer dollar, because I think there is so much good news getting priced into Europe and China right now. And if the Fed continues to be hawkish, if inflation comes down but slower than expected, I think that's going to lift the short end a bit more and also give a lift to the dollar. I also think being long the dollar is a good hedge against the ugly things that could happen, like a step up in the war, or other risk factors that cause people to want to stay patient. Now, we didn't talk about the debt ceiling at all. And that would be another risk factor. And you say, do I still want dollars? If we have a debt ceiling showdown, I'm early days. I don't have a view yet on it. I think about 2011 and trading through that. And I remember within weeks, the S&P was down almost 20%. Bond yields rallied, the dollar rallied. Gold was up about 18%. So maybe having a little bit of gold is not the worst thing in the world in your portfolio right now.
I like it. Dana, when it comes to keeping an eye on all of this, and as Rebecca said, this rough year, pay attention to the data points. What should we be looking at?
Sure.
Like,
So,
sorry, to put some context around it too, like, there's a lot of data out there. What is going to matter for markets if you had to highlight a couple things?
Sure, I think inflation, number one, is going to matter. And that's because that's going to drive the Fed's actions. We're in the camp that the Fed is going to raise rates, like I said, a couple more times, and then maintain them there for the balance of this year, not really consider any rate cuts until maybe the early part of next year. So I think that's something to watch, but what's driving inflation? And that's going to be the consumer. The consumer is going to decide whether we have a soft landing or whether we have a short, shallow recession or something really awful, right? So consumers, as was already mentioned, are spending. They're using credit cards. Most of them are working. The unemployment rate's at 3.4%. Who would have imagined that, right? And as long as they don't fear layoffs, they are going to continue to spend, right? And so that's going to feed into how comfortable companies are feeling. And indeed, when we look at the spectrum of industries, we have a subset of industries that are letting people go. Those were the pandemic darlings, right? Like retail, finance, technology, manufacturing, and then also warehousing, and to a certain degree, transportation, freight transportation. But apart from all those other set of sectors, most other sectors are doing okay, and they're not looking to let people go. So with that backdrop, it's really how the consumer feels. If the consumer starts to feel that the tea leaves or something's in the tea leaves, things are bad, and indeed our consumer confidence index has been signaling recession for almost a year. And if that continues, then we'll start to see things slip. right? And we'll see consumption potentially go negative, which would contribute to negative domestic demand. Because I'm not just looking for GDP growth that's negative, because you can get there in a quarter if inventories and trade are wacky. But the consumer and domestic demand, including businesses, weakening. So I think those are two things, certainly inflation and drivers of inflation, which includes labor market dynamics.
And then Megan, you've been communicating your more bearish view on the market and spreads since you put out your outlook. What would make you change your mind and go in the other direction? What would you look at to feel more positive about our situation?
Good question. So we've been more bearish, I think, to your point, it's been uncomfortable with the continued rally in spreads. I think we are seeing evidence that the fundamental piece is starting to play out very slowly though. I think if we're wrong, it will be on fundamentals and that we've underestimated the strength of the consumer and that corporates can actually make it through without seeing a rise in downgrades and defaults. I think if you look at credit spread pricing, the widening we saw last year is pretty much exactly in line with a bear market without a recession. So I think if we're not having a downturn, if we don't have a recession, credit has played out in your typical bear market style. If we do see a recession though, we think we'll go much wider, which is still our base case. I think the first place we would look for as evidence that we're wrong is in the loan market. So if we don't see downgrades pick up in loans by second, third quarter, I think that would be a sign to revisit the view.
So I'm going to dust off an old analogy. You're all probably tired of it. We haven't heard it in about a year. So what inning are we in? Rebecca, you can start.
Looking at me.
Yeah, like,
I
I don't know if we
Baseball.
started a new game
All right.
or if we're in the
I'm more of a football girl, but I'll try. So, all right, sticking with the analogy, I would call this a 7th inning stretch in a 9-inning game. So I think we're late cycle, and I think we're seeing a pause in the deceleration thanks to the reopening in China, feeding through to the global economy. But I think that's more of a pause than a change in the trend. So I still think we're late cycle going towards a recession.
Megan, what about you?
I think 7th or 8th seems right to us after the kind of surprise payrolls number and the more positive ISM services. I think both of those tell you that we're not heading into recession in the next quarter or so, but I do think the pickup in downgrades and loans that we've seen and some of the fundamental results this quarter where we're seeing a pickup in earnings revisions down and that trend we expect to continue. So I think that we are still headed into a downturn.
Thanks. And then Dana.
I guess I have a slightly different view. I feel like we're at the beginning of a new game.
I
Not
was
the
gonna
beginning,
say, are we
towards
in
the
the same
beginning.
game? Because I was in the 7th inning about
Well,
4
I
years
think-
ago.
I think that this game started in like 2019, right? And we were essentially trending towards a lower equilibrium for growth in the US. And then we had 2 big shocks, right? You had the pandemic, and then you had war, and those kind of disrupted things. But now we're gonna head back to the game, right? So you had a big rain out, right? And everybody had to just put on their hoods and stuff. Yeah, and, go get a hot dog or whatever. And now the sun, the rain's gone, but it's still really cloudy. And I think that, we're headed, right now it's kind of the flip side of all the strength that we saw, right? So I still see this as the weird part. This is still, it's still, the field's still wet, it's kind of drying, right? But then next year, when we're beyond, the pandemic and inflation, elevated inflation and the rate hikes and all of that, we're still going to head towards lower equilibrium growth in the US and in many other economies. Why is that? Because we're going to have less impetus from labor, right? Because you have all these people leaving the labor market. And unless you see massive improvements in efficiency and productivity in innovation and digital transformation and adopting new technologies like Chat GPT, which everybody's using all of a sudden, 2 weeks after it was launched. Even we're using it. 106-year-old institution. But all that absorption, all that needs to happen in order for there to be faster growth. And we're just not that optimistic. So I think this is still part of the disruption in an early part of a very long game.
Thank you. So we have a few minutes. Are there any questions for the panel?
I was wondering, you didn't put so much emphasis on energy prices as a factor of inflation, and from what I understand, it's a major factor, and also you see profit margins staying in companies who use energy, those which I follow, which produce energy, you've seen profit margins widen, in part because asking sometimes from that producing very much has. So I was wondering how you fit that into the program.
Sure, I'm happy to tackle that. The two questions are why didn't, I guess, all of us collectively didn't focus that much on energy price inflation. And also the second aspect was with regard to the fact that you have seen, at least for some of these energy companies, they've done well in the last year. Is this going to persist? So I didn't put a lot of emphasis on energy price inflation because it's come off. When I look at the contributors to consumer price inflation in the US, energy prices were definitely the story of the summer. Now they've shrunken down to almost nothing. Now, I don't think China reopening is actually going to produce a surge of oil demand that will influence global prices. Some of the things my colleague mentioned, but I would also add that Chinese consumers have lost a ton of wealth. Why? Because their housing market imploded. And so they don't have that excess wealth. They also didn't have those supports from fiscal stimulus and little red envelopes going to them. So they're probably going to be much more reluctant to spend, right? And then when you think about factories, well, the factories have already been open, and really, unless you have, a big surge in factories, new factories opening, and also consumers run out there and engage and drive up transportation costs, you're not going to see this big swell in energy. And our MENA economist, he basically has a very narrow range, like $10 for where oil prices are going over the next year, because we don't really have an impetus. Now, if you do have another round of badness and terribleness regarding the war in Ukraine, and Russia does something new that forces energy prices globally to be higher, then okay, but I don't really anticipate that. One of the reasons why energy companies did well last year was because prices were so high, but now prices are kind of normalizing. So unless OPEC decides that it's OPEC plus, which includes Russia, that they're going to really ratchet back production, we're probably not going to see much increase in energy price inflation. And over the next 20, maybe even 30 years, fossil fuels production is going to continue to be important. Right? Because if we look around, almost everything uses natural gas or oil or some kind of fossil fuel. So we need to transition, but we don't have the technology or the infrastructure to get there. So there's still some upside for fossil fuel companies. But as you notice, many of them are becoming energy companies, right? Including all types of energy. And I think that those who are able to adapt will continue to do well. Those that can't are just going to die, just like the whalers who used to get oil from whales.
Okay, thanks. Let's take one more quick question. Who was first? Go ahead.
Hi, just being a fixed income investor, I want to ask a question about the yield curve. So the yield curve has been inverted for most since the 1980s. So what do you make of that? And then when do you think will return to the positive curve? And consequences like that?
Rebecca, do you want to take that?
I can start. I would guess we all have thoughts. Oh, yes. So the question was about the yield curve. So we're currently looking at the most inverted yield curve in the United States that we've had since the 1980s. Is it gonna stay like this? When does it turn? Do we care? You didn't ask if we care, but I think it's worth adding to that. Ad-lib. We do care. Obviously, it's interesting because you've seen yield curve inversions that predict recessions that don't happen, but every recession that's happened has had an inverted yield curve. And I think there's enough data to suggest that the information in the yield curve is actually helpful to understanding what's going on in the economy. Last year, I think one of the reasons that we saw the long end of the curve rise, that we saw bond yields rise so much, the 10-year up 4.5 or so, was because you got the stimulus from the pandemic, right? The government handouts went to consumers. They had all this cash. They had them in deposits. They put them with the banks in deposits. The banks wanted to get a higher yield. And so, it was the other way around. So you got banks moving down. Am I getting this right? I'm getting this backwards. You had to move last year from deposits into longer term yields that pushed yields down initially, excuse me. And then later in the year, as you stopped getting that flow of money into deposits and the curve flattened, and so there wasn't as much interest in going out the curve, then we started to see the 10-year yield rise. Now, what I think we're seeing today is a little bit different. Now that yields have risen so much, we are seeing actual demand coming back for longer term bonds, both from foreign governments and foreign entities, from longer term players like insurance companies, and some retail demand, just because the yield pickup is now deemed attractive. I still think you're getting a lot of interest also on the front end, but it's more mixed. So what's really driving my view is not the long end as much as the front end today. And if the Fed is going to raise rates another 50 basis points or so from here, we could see that curve stay quite steep, both on expectations of the recession and the demand from those different sets of players this year, which is very different from the second half of last year. Sorry, I garbled that a little bit.
Megan.
Yeah, I think the yield curve is one of our inputs into our credit cycle framework. It would suggest downturn along with some of the other metrics I talked about. I think from an investor standpoint, I think it's one of the main factors that makes IG look attractive. So front end IG, we've seen a lot of buyers of the yield you can pick up without taking much duration risk with relatively low spread risk as well. So I think that's been a really positive dynamic for credit.
And Dana, last comment.
Sure. In terms of like recession signaling, the yield curve, yes, is an important aspect, but I think some of the signaling it provides is muddled because of quantitative easing, which basically is like a thumb on the back end of the yield curve. Now, the Fed is drawing down the size of its balance sheet, so that thumb is lifting, but it's lifting much more slowly than the front end, where interest rates, short-term interest rates are rising very quickly. So I think there are a lot of dynamics going on with that. So until the Fed stops hiking and the roll off of the balance sheet kind of catches up, you may still have some of that downward pressure in addition to the things that my colleagues have already mentioned.
Well, thank you. I just want to thank Megan, Dana, and Rebecca for all their great insights. To Joyce.
Thank you so much, Rebecca, Dana, and Megan for your comments. And I'm going to welcome Penny I want to make an announcement that she lives in Marsh is unfortunately ill today and will not be with us. But I do want to invite Penny and Janet to come up to join me. But first, let me just start by saying how wonderful it is just to be in person with all of you at this amazing space for women. We've done this online, but I want to encourage all of you to stay involved with the Aussie. It is an organization that includes the buy side, the sell side, quant analysts, index groups, the rating agencies, and academics. And just a real special thank you to the Federal Reserve Bank of New York, because it is just great to have the policy dialogue here. And a shout out to our men as allies, because there are some men in the room and in the audience. I think about 15% of the virtual audience, but we just very much appreciate all of the partnership and look forward to continuing the dialogue. So I am just delighted to introduce, I'm going to call us veterans of the industry. Oh, okay. I do have it on.
Yeah.
So I'm going to choose to call us veterans of the industry, not old timers, because it's between Penny and Janet and myself, I think we have more than 110 years in fixed income. But there is longevity in this space, but just so delighted to be here today and having it at this time of year when the fixed income markets are doing so well. So how did we get to where we're at before I start this conversation? So we are calling this the year of the great repricing. Bonds are back. Fixed income is back to being investable. After 253 billion of outflows last year, we've seen almost 40 billion come in the month of January. We're hearing that we're below the historical median on high yield as we look at CMDI. And we're really passing a year where it is regime change. We had central banks, ex-China and Turkey, raising policy rates 300 basis points, inflation as high as 9% in the middle of the year. And here we are now, though, with default rates that are going down. So is this all sustainable? And I think one of the big silver linings from last year's market crash, which we think was the worst since 1937, 17% returns, is that this great repricing does bode well for future returns. So back in 2020, when we looked at the potential returns for 60-40, we were looking at only 3.25%. We now think that's 6.8%. And that's partly because you've got high yield, high grade over 5%, the US Ag at 4.6%. And we think you're going to see more allocations going from equities into fixed income. If you take a look at just the pension overfunding that we've been looking at, so we think that US households have record holdings of equities, 43%, bond holdings, we think are around 17% where they were at Lehman. So if you look at the pension overfunding, even just a 3 to 4 percentage point at AUM move, in our model show it could be $1 trillion of outflows from equities and into fixed income. So it's regime change, and we are seeing a transition from pain to gain. But fixed income markets have recovered very, very quickly. And I think Anna really made the good point that the velocity of this is one thing that we're all grappling with, as well as the market liquidity, in addition to looking at the fundamentals. So I think there is a bumpy road ahead. And you can tell you're at a fixed income conference because nobody's buying the pivot. Nobody thinks that the Fed is going to pivot. I mean, we are looking at also at JP Morgan, 2 more rate hikes, 25 basis points, and a soft landing scenario that I put at 25%, but a pause, and then perhaps a pause, but the pause is not enough, alluding to just the concern that Rebecca raised. I mean, are we going to need a higher terminal rate? So a lot to talk about in the session. But I'm just very pleased to have Penny Foley, who's Group Managing Director for Emerging Markets, member of the board of TCW Group with us, Janet Clay, who's Managing Director of Research for High Yield and Leverage Finance for Fidelity Investments. And before we get into the markets, they have seen so many cycles that I actually want to hear a little bit more about them before we talk about the markets. So Janet, you have been in the credit markets, in the high yield market from its infancy, as has Penny, from Drexel Vernon days. And so do you have like a favorite lesson from your early days on the road, or a key event or experience that you would highlight? And how did you end up in high yield to begin with, which was a little known and pretty male dominated market back in the early 1990s?
Well, thank you, Joyce. Well, how did I end up in high yield? I ended up in high yield because I was in another fixed income market that disappeared. I was, oops, there you go. I was working in what they call global fixed income, and I was investing in bonds that were denominated in things like French francs and Deutschmarks and lira. And guess what? Then the euro came around. There went that career. So I was fortunate to get an opportunity to switch to high yield, and we're in the same company, and I was like, sure, that sounds good, it keeps me employed. So that's how I started, and some of the lessons I've learned over the years is that As a fixed income investor, we always want to get the numbers down, want to put them all nice together, want to see the cash flow. And it's really important to sort of pause and step back and look at the companies and look at the industry that you're investing in, because some of them, when you start looking at them, you think they look great. For example, paging companies were really good when I first started out. There was a Blockbuster that was a big issuer. There was, some people probably don't know this, but then there were things like, so some of those went away, obviously, also Yellow Pages, I will mention. But then there were some things that showed up that if you weren't really thinking a little more broadly about the impact or what could happen, you missed it. And I will give an example. I bet most of you don't realize that Amazon.com once was a high yield issuer. And I happily put pass in response. So the lessons I've learned is that you really have to think about, okay, what are the opportunities? What are the possibilities? Because that's something that's important for your whole career. And we can talk a little bit more about that. But those are really, really important.
Thank you so much, Janet. So Penny, let me come to you. So Penny actually started very early in her career at the Federal Reserve Bank of Boston, but has been in the market, I think actually is the longest standing woman I know in the market. So just, yeah. I'm not going to say what year you were at the Federal Reserve Bank of Boston. But Penny, I just want to sort of move, how did you move from like high yield, from the, into the international realm, into emerging markets, before it was even called emerging markets, when it was still the third world, less developed country debt. Can you talk to us a little bit about what attracted you to emerging markets? And also, you were also sort of on the board of TCW, which I think many of you have read, has just announced their first female CEO, or Penny was part of just that whole sort of search and recruitment committee. So how does being on the board of the company also change the way that you think about leadership and investment strategy?
Thank you very much, Joy. Yes, thank you very much, Joyce. I'm delighted to be here and see all these faces, including the male one. I started at Federal Reserve, as you say. I studied economics. That's one of the whatever percentage it is, and that was terrific. But then I got married and moved to New York, and Lehman Brothers offered me $500 more than the Federal Reserve in New York. That's an annual number, not and so I joined Lehman, and I'm in project finance and U.S. domestic finance. And I was then recruited by Citibank about 6 or 7 years later, who was starting an investment bank, which was obviously only international at that point, Glass-Steagall. And it was great. It was entrepreneurial. There were 4 of us in a small area at Citibank, and that's how I got on the international side. And I was involved again in project finance. We set up domestic credit, domestic money market operations in some countries in Latin America, and then of course Mexico defaulted. In fact, I was one of the people who worked on the last Eurobond for Mexico before the default. It was not surprisingly the Pemex. And then, there wasn't anybody who wanted to do restructuring. So it was the juniors and syndication area that got sucked into doing that. And it was a fascinating time because policymakers said, this problem's going to solve itself, interest rates are going to come down, and commodity prices go up, no problem, 1%. We were then recruited to Drexel, who thought there was some real opportunities to trade some of this distressed debt. Mexico is trading at 35 cents on the dollar, that's a dime. Peru at sort of 5 cents, taking the crude into account. So we went to Drexel. We all went to the West Coast. There were 7 or 8 of us, and started a trading operation in what was then called less developed countries. And when that was a great business for a couple of years. And then we were also involved in talking to investment bankers about the possibility of trying to do a real corporate type restructuring for these countries. So instead of this nonsense about rates will come down and commodity prices go up, the problem solve itself, let's look at this as if it were a corporate restructuring. Think about ways in which we can analyze debt sustainability and then create exchanges that will get us to that point. And at the same time impose orthodox economic policy. So there was tariff and couple of sticks. And, you know, we moved along that way, and we thought things were really moving along. We were excited about that. And then sometime in 1987, Mike Milton, who was running the desk at the time, came over and said, I think we should start a fund. We thought he was nuts, so we just ignored him. And about a week later, he called and said, how's that fund coming? And luckily, you know, he was exactly right. It was exactly the time. Nobody wanted to hear about it. But luckily, someone had rebranded less developed countries to emerging markets, much classier. And of course, Mike had made a lot of money for people in areas that they didn't really see as potential, like, you know, like Las Vegas, like, you know, some telecommunications companies. And so he was able to raise 180 million bucks for us. And that was the beginning of what's now a $12 billion.
Thank you both. And I want to say that Julie unfortunately cannot be with us, but I think many of you have read that she was just promoted to the deputy SOMA, the Assistant Open Market Account Manager. So we wish her well and hope that she will be with us on another occasion. But Jenna, I wanted to come back to you before I talk more broadly about the market. So you have worked at Putnam, John Hancock, State Street, Liberty Mutual, you know, and Fidelity. And how do you actually look at the different styles, you know, from the different funds that you've worked at, from mutual funds to insurance? What are the different approaches to fixed income management, and how you manage people, especially women?
Well, when you list
When you list off all those companies, it does sound like a sample plate of
places that I've been, who's dying on me. Anyways, I got a loud voice.
They have to hear
Yeah,
you.
so-
Oh, yeah, the
Yeah.
hybrid.
Thank you. So, but- They're both dying. Oh, that's very good, thanks. So it was interesting because obviously every investment firm has slightly different mandates. Certainly working for an insurance company, in this particular case at Liberty, it was one client. We didn't have to go raise funds. Oh my God, it's like magic. The money just comes in and we sell policies. It's supposed to be the thing in the world. And even when there's a cat, which the first time I heard, I thought was a nice furry animal. When there's a catastrophe, people don't get all their claims in right at the same time. So you're never a forced seller. So talk about a really enjoyable way to manage money if you can do a total return, which fortunately we were able to do there. Other places when you have the mutual funds, ownership matters. So when I was at, for example, Putnam, when I was at State Street Research, they were owned by big insurance companies. And you know, the goal there was to sort of siphon off as much money as possible versus necessarily reinvesting it. Obviously, flows mattered. You had to manage those. You had a lot of different clients. And some of those clients were sophisticated and some weren't. I'll never forget one time, you know, the market was tanking and someone called and said, could I talk to the CFO? He put all of his corporate cash in the high yield fund. Oh, good, yeah, great. And the beauty of coming to work for a place like Fidelity is that it's privately held. Its number one thing is making money for its shareholders. And the whole focus is what does it take for the shareholders to do well? And they invest back in the business. They want to be leading edge. I'm working with the brightest group of people I've ever worked with in my life. They're not that easy to manage when they're that bright either, because they have a lot of demands, but it's terrific. And so, you know, from a woman's standpoint going through the years, I think the hard thing was often in the early years, you were the only one in a certain degree. I think people thought, okay, we're gonna hire a woman, let's have one, and that was it. And I think that also unfortunately led to women not necessarily partnering up in the workforce because they're like, oh crap, only one of us is gonna make it. So guess what, you know, we're not gonna be that nice to each other. Thank God that has changed. And you're seeing a much more diverse workforce out there, diversity of thought, diversity of backgrounds. And just it's not so unusual anymore. But certainly the difference back then is you were often excluded from a lot of things because you were a woman. They just would assume you wouldn't want to do things. And the good thing is a lot of that's changed, so that's great.
No, I mean, a lot of changes also, and I sort of started like, around the time where it was just transitioning from less developed country to emerging markets. And, you know, it is just good to see just the whole diversity that has kind of come into the industry, gender and otherwise. So let's just get into it about the markets. So Penny, let me just start with you. So coming off of zero yields, so zero yielding debt had peaked in the first quarter of 2020. at $17.2 trillion. It's now $1.5 trillion all in Japan. Even the Japan portion fell by $1 trillion since BOJ moved in December. So we're out of the, we're into this positive yielding world now. And so how is this changing the strategy at TCW as you look across fixed income, equities, emerging markets, and alternative assets? And are you seeing rotation? And how are you looking at the inflows and where the market is headed?
Okay, well, we're largely a fixed income shop, so so we had a pretty miserable, 2022, and things are looking a lot brighter. And I'm on the board, as Joyce said. One thing in terms of what you learn and being a woman in business, that one of the things I learned is that if you move in the right direction, don't worry so much about why. I mean, I was put on the board because they needed a woman on the board. Once they open that door, it's really going to be hard to close it. So instead of saying, I want to be on the board for the right reason, I just said, I want to be on the board. And then over time, you begin to develop, relationships. People say, that person really can think. So one of the big lessons I've learned. The other is to stay away from conventional wisdom, because it is just that, conventional. And that's not as helpful. In terms of what we're doing on the board, in terms of product, we're obviously trying to grow our basic business, which is a really solid both U.S. and international fixed income business. And we're focusing on getting into new areas through adjacencies. So, doing things like, for example, we launched, an absolute return emerging market strategy alongside, our relative return strategies. To do multi-asset type strategies. For example, we're just launching, an global ESG fund, which is run by our US and our EM portfolio managers together with the head of our ESG group. And then we're looking at getting into new areas, but that leverage our strong sort of fundamentals-based research infrastructure. So that's kind of the way we're looking at moving in the markets. In terms of emerging markets, it's been, obviously a miserable 2022. It's nice to be able to say we outperformed 30-year treasuries, but that's not really getting very far. And we've now, I think we're now in a position, I think just in terms of the macro environment, that is actually quite supportive. The question has been asked a number of times today, have we already priced that in? So we have now an environment in which growth in EM, relative growth in EM, that spread is widening. It's as wide as it's been in 10 years. That's usually very helpful in terms of inflows. We're looking at a dollar that is still, despite its drop since last year, is still close to the 2000 peaks. And actually, last year's pace of dollar appreciation was equivalent of 1972, which is when we went off the gold standard. So pretty dramatic stuff. And that was really reflective of relative growth, relative rates. And I think and that's really sort of the US exceptionalism story that you guys talk a lot about. I think those two drivers are fading. It could be that certainly in the near term that we're going to have a bumpy time, but I think it may well be for emerging markets that the dollar strength doesn't have to be terribly weak, but the dollar strength will subside, and that will be, I think, very good for EM. The other thing about EM is, carries back. I mean, we now have 5.5% carry in IG, 7% in double Bs. We have 10% plus in single Bs, and single Bs that are likely to default or have a run of trouble are pretty well telegraphed. A number of them have already defaulted. Others have approached the IMF for support. So while there's certainly a lot of risk in the markets, there are things that are, I think, are developing in ways that are very helpful. And default rates are priced in on the sovereign side way higher than historical, historical experience would suggest. So, for example, triple Bs, you've got priced in something like 11%, and historically it's been sort of 1 to 1.5%. Markets pricing in close, I think, 20% for double Bs, and that's typically been closer to mid-single digits. And, you know, the emerging markets is now what, 25% of global fixed income. So, and you know, you know, positioning is probably middle single digit sort of range. So you have a fair bit of technical support from the markets as well.
No, thank you so much, Penny, for that. And I think you're right, like all of us were sort of in this very bearish second half of the year. And then we saw three big changes. The Bank of Japan surprise. And so this whole period of FX vol dollar strength came down. The warmest winter in Europe since 1950. All of the tail risk on gas prices came down, and then the U-turn from China on reopening. And so everybody sort of had to scramble to catch up with the way they had been positioned in the second half of the year. So Jenna, let me just come to you and on this whole question of default risk and where we are putting the recession risk. I mean, what are your expectations for high yield default rates? You know, CMDI is showing that's below the historical trends on some of the high yield stress. How are you looking at just, you know, issuance this year, what the appetite is, what total returns will be? I mean, are you getting paid to step up into high yield? If you can get 7 or 8% in the high grade, does it make sense to buy high yield? And how worried should we be about leverage in the system? How do you compare this to past cycles?
So this is where I need a disclaimer that anything I say is my opinion and not advice. I guess I always, to a certain degree, I feel like things never get as bad as people think they're gonna. And so when I look at the default rates, it's a funny thing because we talk about with high yield, oh, the market default rate and the macroeconomic conditions. But quite frankly, in high yield, you know, there can be sunshine in one spot and complete torrential rain in another. It's so dependent on the industry and it depends on the companies in terms of how you invest. That's why it's really important to go with a, if you're gonna put money to work in high yield, that you're with a, you know, someone who's done it for a while. Because I you know, personally, I think after such a tough year last year, typically high yield doesn't have 2 bad years in a row because people start to figure out, okay, everything got thrown out, they got thrown out with bathwater. Let's find those deeply discounted, attractive investments. It's a great year to be an analyst because you really do have to pick through this stuff and people are gonna listen to you. So I look at it as it's positive that way. It's interesting about the default question because, you know, if you look at the high yield market, it's actually hasn't had a lot of issuance. You know, a lot of the issuance has gone to the loan market. You know, we've seen direct lending, private lending taking a lot of the flow. So there does seem to still be a large desire to make sure that there's solutions for companies that get in trouble to keep them going. So those are some of the things I think about. The other thing I think about is we always start the year with all these forecasts, and everybody's forecasting what they think is going to happen. But in my experience, every year there's something that comes up that we weren't expecting. And you know, some of the things I think about are, you know, we've talked about China, but when we talk about we could go to war with China because you know right now obviously we don't have the greatest relations there. There's a lot of history that shows that you know when there's you know, powers like the U.S. has been such the established world power, we're not growing like we used to. There's other countries that are coming up the pike. Does that cause a friction that then you know blows up? And then we also take you know the word of the Fed that 2% inflation is the gold standard. Well, what if they turn around and change that? Why is it 2%? So these are things I try to think about as the year goes on and to sort of stress test my investments and to think about, okay, what will returns look like? You know, what will the default rate look like? And so I've got a positive view on high yield. And in general, I think it's a great asset class. First of all, because it's so much fun to work in, but also, you know, it's got good yields right now. There's some really great companies, and you know, everybody. The good thing about the Fed is they've telegraphed what they're doing, so management teams are really scrambling to make sure, you know, that they manage for the higher inflation. I mean, it's tough. We've got a lot of business models in the market, a lot of, you know, PE firms that brought LBOs that aren't predicated on higher rates. So, you know, there's definitely going to be some challenges along the line.
are you worried about leverage in the system this time? How do you think it's different? At what point would you be more worried about?
So it really, the leverage thing is very funny. I mean, I started in the business when we were actually maintenance covenants and loans. And, you know, you're just seeing the goalposts move, and obviously what is more concerning is recovery rates. You know, certainly it would be concerning. It's really hard to know right now on the leverage. I thought it was really interesting about the fact that, you know, we don't have like this, we were talking about how we don't have a repository to know where debt is being lent. And there's just been the whole explosion of direct lending, and, you know, how that is impacting the markets, I think it's still to be seen. And so is that more leverage at smaller companies that wasn't there before? Is that going to cause some challenges in the economy? I'm not worried necessarily about regular straight high yield companies.
Yeah, no, it's
No.
it's the more what we.
The shadow markets.
Yeah, and what we talked about in the first session, that, these are some of the unknowns. But Penny, let me come to you, and, so we've had that, emerging markets has been hit by so many blows, like whether it was the China, property market, Russia and Ukraine, among all of, just very volatile elections in many of the countries, turbulence in Latin America. So, like, how do you talk about the emerging markets risk when you're trying to attract crossover investors? And I was on a panel where one of the comments was, well, people are comfortable dating emerging markets, but they don't want to marry them. And do you see that, is this something that really can become more mainstream? Because I feel like both of us have talked about just mainstreaming for emerging markets for now a number of decades.
Yeah. You know, and certainly I think looking at put in two spots, I think hard currency markets should be, an allocation, and you could be overweight, underweight, or somewhere in the middle. I mean, we think fair value today is probably somewhere between 400 and 450 over. We're now around 435, so we're in the fair value range. Now, that's way wider than long-term averages. Long-term average is about 300 if you take Venezuela out. And we don't think we get back there anytime soon for a number of reasons. When you and I were running around talking about less developed countries, yes, there were I think in 1998, the MD was 10 countries. It was in 2008, it was 34 countries. Today it's 7 countries, and it ranges from AA UAE to CCC El Sal. So you can't really go and say this is you got to buy emerging markets, because there are just so many different drivers and themes, and I think that the key in the future is really to create a portfolio that recognizes differentiation of themes, and the themes could be better governance, for example, or better terms of trade, because China in fact does grow faster than people are expecting, or a better reform momentum, or globalization that moves into a regionalization kind of process. So Latin America benefits from from flows from China into the Western Hemisphere. But I think the portfolio's are really going to have to take into account that differentiation in building themes. Local currency is another animal entirely. It's been over the last decade. It's been the most disappointing asset class that I can think of. I think it's outperformed maybe for 3 months at a time, twice or maybe 3 times. And I think what is a really interesting opportunity to focus on, and I wouldn't bet that it's a really long-term one, but that if in fact we're right, the dollar is either going to be stable or weakening in this environment as the ECB is a little more aggressive than Fed winds down. Growth upside surprises continue outside of the US. China really makes a difference. That could make local currency a very attractive asset class. I think one of the things I worry about all the time is that this may be a year of not just plan 12 months ahead, plan maybe 3 months ahead. One of the problems is a lot's gotten priced in the last 3 months. well, we keep saying, oh my God, the whole year is gonna happen in January. And I hope that's not true, but it's certainly, I think we're certainly due for a period of consolidation here, no matter what the news. And I think that, I think that the debt ceiling discussion is a huge risk. And last time around, as we heard earlier, it's really, it's really a risk off period where, where rates did very well, and the US Treasuries did very well, everything else did very poorly. So that could really put a hole in the story. But I think longer term, the environment for EM, we've got, better growth on a relative basis, presumably stable to weakening dollar over time, given where we're starting from today. I think with a differentiated portfolio, recognizing some of the things we talked about is a pretty interesting alternative, but keep stinkers on.
Thanks so much, Mania. But Janet had also mentioned recovery value. I mean, one of the concerns I have is just for the countries that are restructuring. Like if you came in the 90s and said, I'm going to buy it at 30, it's going to 60. I mean, are you actually coming in at 30 and it's going to 15? So I think your point that is the unbig just too big, you have to be very selective here. You need the credit skills right now, the differentiation is a very good point. I want to talk about market structure, market liquidity, market velocity, because we've talked a bit about the fundamentals and just sort of the more constructive tone that has come out. But like Janet, what do you see are the biggest challenges today? And one of the things that we've looked at is that we are looking at for what we call rising stars, upgraded from high yield to high grade, 160 billion of downgrades to high yield, only 15 billion. But I don't know if you can talk a little bit about just kind of how you think about market liquidity and the horizon that you look on. So when we put together that sometimes the market can have these non-linear moves that you have to take a 3-month view, not a longer term view, like how do you think about just time horizon, market liquidity and market structure?
All good questions. In terms of looking at the market and market liquidity, I think one of the biggest things that has occurred is that the markets now move so much faster on news. I mean, I will tell you, when I first started the business, it was so cute. We had a little library, and the 10K queue would get mailed to the company, and I could call, they come pick it up. And now the information is instantaneous. You have to absorb it immediately. I would say if anyone here, get comfortable manipulating data, because that's going to be a bigger part of your life and not just fundamental credit analysis. Because it moves so fast, those windows of liquidity can dry up really quickly. You have to really feed the fishes, and the fishes are hungry. So that's what I think about in terms of liquidity. In terms of what was the other question? Sorry, what was the?
Just market time horizon.
Time horizon, yes. So we'd all like to, in high yield, we'd love to say we're going to hold things until they get, refinanced or. There's no such thing as maturity in high yield, let's be clear. But honestly, the challenge with high yield is that when it gets in trouble, things can go a little haywire fast. So yes, I'd like to see a forecast out a few years, because at least it requires some discipline to think about, what you're expecting. Because when you put a lot of debt on a company, it can't keep going like that typically. You've got to have some catalysts to make the cap structure work. So that either means the business has to grow, or they've got to cut costs, or they've got to make some very key acquisitions that are going to be accretive. So thinking about that and forecasting your model is really important. But on the flip side, you've got to be on top of these things every quarter. I mean, I used to say every high yield company is only a few quarters away from bankruptcy, but it's the truth of the matter. These companies get into trouble fast. So you've got to be quicker now. You've got to be ready. You've got to know your credits. You've got to be ready to take advantage if there's any liquidity, because it's fleeting, and it can be quite violent, the moves.
And are there certain sectors, like where are you most concerned? Where do you feel like they're going to benefit most from the recovery?
I'm still a fan of consumer related stuff, even though I know that everyone's like, oh, the economy or whatever, but I think there's still a lot of pent up demand to travel, to do things, to see people. So I think I like personally still like that area. I like defense sadly, because I do think there's gonna be more demands. I mean, you just even look at, just the general unrest in those countries, it's still pretty, populations are pretty divided. You can look here in the United States, and the one thing we didn't even talk about also is an election coming up in 2024, and typically, if you look back in history, if the economy isn't doing well, the incumbent does not get another chance to play president. That's another concern that I have. And then also then on the invest in anything that does political advertising, because it'll be, that continues to explode as an area. So yeah, no, I just, that's sort of where I'm at.
Thanks so much, Janet. So let me come to you, and I want to just talk a little bit more about China and China's reopening. And just came back from Asia a few days ago myself. Like this was a U-turn. We've seen a big market rally. Do you still see value here? And how do you look at China sort of over the medium term from an investment perspective?
Well, from a fixed income perspective, there's less opportunity in China than if somebody wants to, that's someone who works for you, you buy what, you buy what China, you buy outside of China that it doesn't have. And so, I think the opportunities for us are in areas like metals and mining, like energy, like, Asia inputs for China manufacturing. So we have very little exposure to China per se, other than in currency, basically neutral. Very little exposure. But I think the opportunity for China growth, I think without doubt, it's happening faster than people expected. The opening was faster than people expected, and clumsily handled, but it's going to mean people are going to be out and about sooner rather than later. So we do think that we're probably seeing growth this year of somewhere in the area of 5, maybe 5.5%. A lot of that will be front loaded. That number. We think China does represent an opportunity in the short term for both manufacturing and resource companies. In terms of liquidity, yes, liquidity is lousy. I think some of the regulatory environment that was introduced after the financial crisis really, what happened with our markets, there used to be something on the order of 300 to 400, billion of balance sheet that was dedicated to trading on the EM space on the sell side. Today, it's probably 30, and I doubt that that's fully utilized. So liquidity is really a challenge, and it's particularly a challenge on the corporate side. Even though there's some very interesting ideas, there are fewer people trading the debt, and it's really, I'll do $1 million, I'll do the other 4. So we have a pretty big mutual fund, and that really limits what you can do in a lot of the other thing that is to confirm, said earlier, is that the time horizon is gone. Gee, I have a whole, I'm gonna buy a whole invested, a holy cow. You've got to move very, very quickly. And what happens in our markets, I'm sure it happens in some of your markets as well, is that it's shoot first and then ask questions later. So we have something like we own Adani Green bonds. They're sustainable bonds. They got, and yet we got hammered with the Adani, which was more related to something. So no matter how clever you are in your analytical process, you have a reputation that you take into account throughout, and things move very quickly, both down and.
No, and when we look at market liquidity, it's not just the emerging markets. I mean, even in the U.S. Treasury market, our estimate is that market depth is probably about 60% lower than it had been sort of pre-pandemic. Yields and balloons also, and that crisis will occur in EM frontier markets, but also in the places that you wouldn't expect, like UK LDI. So market structure and liquidity are just 2 areas where we've had to just put a lot more focus. So I want to ask both of you, what do you think is the biggest challenge in markets today? And and also just to talk about just sort of like even people management, like biggest challenge in markets today, biggest challenge in managing just sort of your franchises.
Well, I think the biggest challenge today in the markets is just, obviously, it's great as an investor to see the high yields, but, can the companies sustain it? And it's been interesting because we've seen a little more activity in convertible bonds, because obviously, if you're a public company, there's some options to invest debt at a lower price than what you got that doesn't convert to equity at a later date, pushing the, kicking the can down the road. From a management standpoint, it was very interesting to go through this downturn. Certainly for some of our early in career people, it was a little bit shocking. You've gone along and you bought things at par and they go up to 102, 103, and suddenly, boom, they're at 80. But of course, it's great to have those experiences early in your career, because then you're going to see them forever and ever, and you're not going to be shocked, and you'll know that there's going to be opportunity. I think the other thing is, we're still in a hybrid world. So managing that communication, I talked about how the markets are that much faster. Making sure you manage that communication effectively in a remote or hybrid environment is a challenge. And diverse workforces are fantastic in terms of all the ideas and creativity. But you now have to, as a manager, it's bespoke management. It's literally person by person, meeting them where they are and helping them through their journey, and people look at things differently. And so when you've got all the markets and things moving fast, it is a little more of a challenge when you've got a workforce that comes from a variety of backgrounds, variety of experiences.
How are you looking at the biggest challenge that you're facing today within the markets and just sort of managing your franchise?
For me, the biggest challenge right now is this environment is the most uncertain that I've had to deal with in a long time from a macro perspective. You've got people who mentioned geopolitical risk, and that they're way out there, they're huge. What's going to happen with inflation, what's going to happen with rates. I've got my own, but there are a lot of risks, a lot of downside, and hopefully upside risks. So I think right now that's what we're trying. And I think that's the first thing I would. The second thing is what we've all talked about, is a lot of good news for pricing in the market. So so upside from here is moderate at best in the very short term, and there are some downside risks that I worry about. In terms of people management, I'm very enthusiastic about the environment that we have now. We have much more diverse workforce, and people are focused on maintaining it. And there's a legal framework around that, so people are a little less cavalier. I've been on the board for 5 years. A couple of years ago, we hired a COO, a woman named Liz Tranker from PIMCO. And then I was on the search committee to find a new CEO, because our other one was retiring. And starting on Monday, Katie Koch from GSAM will be our new CEO. And so I think my work is done. And it's amazing. And we had the search committee was 2 women, 7 men, age range from 45 to 80. So you can imagine different perspectives. And we got down to 4 or 5 finalists. And it's extraordinary that I like him, I don't like her, I like him, I'm not sure about that one. And when Kate came in and we spent, 2, I guess 3 or 4 hour periods with her, everyone signed up. I mean, and that's really amazing. And with that age range, that level of experience, with men who I've sat in rooms with and felt like I'm watching Fox News, they were all enthusiastic about this. And that really is, I think is enormous. And so I'm very excited about the outcome. Now, in terms of managing people, we have a relatively small group, and it's managed kind of horizontally. We've got a lot of folks that have been in the business for quite some time. They're doing, sovereign research, corporate research. And there are a couple of things. One, they get to levels and then they, then what do you do? beyond that. And then they also remember the business when it was a much, more lucrative business, as you will, but it's changed. And, ETFs and others have brought, the fee schedules down and the way people are compensated has changed. That's been a big management challenge over the course of the last, 5 years. But as long as you're paying people, what you think they're worth relative to the rest of the market, people kind of stay in their seats. But it is a.
So maybe I have to ask you just a follow-up country question. So you mentioned this, the uncertainty, the geopolitical risk. Is there any country that's on your radar that you think the risk is not fully priced yet, that it should be on people's radar as far as what you're looking at, that you're concerned about?
There are countries that have already defaulted, so Sri Lanka and Ghana, we, virtually no exposure there because of this thing you were talking about, which is it's taking so much longer to get these things done. There's so many more players, China, the Paris Club, IF types. And so we're staying away from that. There are countries that are approaching the IMF. We have some exposure to Egypt. We have some exposure to Pakistan on the upside opportunity there. I think Turkey is an area of concern. We were very negative on Turkey, but at the kind of rates that you can get in NDFs, it was killing us. So we're now equal weight, but Turkey's obviously dealing with huge problem, natural disaster, and before that, heterodox economic policy. I don't know what the outcome is going to be of the election, and it's got some upside and downside risks, but that really watch that very carefully. And then the other is sort of the pink wave in Latin America. We've had a huge, elections of leftist candidates in Peru, and Chile, and Colombia, and Brazil. And while they have been unable to really change the environment dramatically and very quickly because of the institutional framework, the risk is there, and there's been no focus on a real upside market reforms. On the other hand, those are the countries that will benefit if, in fact, Chinese growth and growth outside the U.S. accelerates. So there's both sides, but those are the kind of the three major.
So I'm just going to do a quick lightning round with both of them before I open this up and see if there's a question or two. But top pick and top pan.
I think I gave the topics earlier. Well, it'd be like defense, be convertible bonds.
Political advertising.
Yes. And it's top right, man. Oh my gosh. I'm not good on there. I tend to be more positive than negative.
Well, in local currency, we're, overweight, high carry, global, so Mexico, Hungary, those areas. And in hard currency, our biggest positions, not necessarily our biggest overweight, but biggest positions are in IG, but we are overweight high yield. We're about 800 basis points overweight high yield, so it's about a 50-50 index, and we're about 58% high yield, but it's with a relatively low beta, so our beta is one, higher beta to IG. So our biggest positions are in places like Mexico. So what are we avoiding? Well, we are, we're an active manager, a total return strategy. So the index at 70, we typically have exposure to maybe 40 countries. So the countries we've talked about before would be the ones.
Well, I know that we are at time right now, and we still have just a wonderful fireside chat and presentation for all of you to learn more about Girls Inc. And just so delighted to have Pam Morado, who is the CEO for Girls Inc. of New York, and Kate Luzio here to just talk more about this. But thank you so much, Penny and Jan.
Yeah. Okay. Good evening. I know we are a few minutes between you guys and cocktails and some light bites, but I just wanted to thank everyone for being here. I'm Kate Luzio. I know Monica referenced it in the beginning. This is actually such a great afternoon for me because prior to starting Luminary 4 years ago, I spent 20 years in corporate investment banking. So listening and being able to hear kind of, not that I was ever in fixed income, but listening and hearing what I was near and dear to when I covered clients for so many years, many of those years at JP Morgan. And so also get to be back with Joyce as well. And Rebecca, who spoke earlier, was one of the most amazing women at JP Morgan when I was there. So it's really delightful. And some of the stats that we went over in the beginning around the lack of women as an economist, the lack of women in the C-suite. It's why I started Luminary. This is a physical space that you're all in, and many of you that are online, but it's really around advancing women in the workforce. And we start that one by one, but working with many companies. And JP Morgan is one of our partners, and Goldman Sachs, Fitch as well, and really thinking about women across the workforce and all professional journeys, as well as women that are in entrepreneurship and those that are in transition. So, but we can't start anywhere if we don't start with girls. And Joyce has served on the Girls Inc. National Board. I then took your place on the national board and then rolled off and am now on the board of Girls Inc. New York City. And I wanted to ask Pam a couple of questions. Our mission at Girls Inc. is to be strong, smart, and bold for all girls. Can you talk a little bit, Pam, just about some of the programming and the girls here just in New York City?
Absolutely. First, I want to say that I'm delighted to be a luminary with two luminaries, and one is a benefit in finance. And we pray that Joyce comes on the board soon too. So, basically, we say our mission to be strong, smart, and bold. I think the thing that expresses how we accomplish our mission best is what one of our recent graduates within the fintech company now, Congrats Ambassador, said. She said thoughtfully, we were being interviewed by The Economist, and Tiara said, I think what Girls Inc. does dismantle the effects of trauma, the trauma that creates intergenerational poverty. And I think that really says it best. We serve girls from very under-resourced, the poorest communities in the city. And if you would have been at our gala last year, Kate and I were at the same table, it was a mission moment. All of our girls that graduated from high school, all went to college, were there, and the sort of equivalent of commencement speaker came from Kenya and talked about the fact that her parents, her family did not believe in educating girls at all. And she said, because of Girls Inc. and its influence, she now was going to Harvard on full scholarship to become a venture capitalist. And that's kind of what we do. Our programs are transformational, they're comprehensive. They range from financial literacy to data analytics, to healthy sexuality, to mind-body matters. There's a major, huge crisis in mental health among adolescents. But they're experiential and our impact is very substantial, as you know. They all graduate from high school, they go on to college, and we have a college retention program that is showing tremendous results.
So one of the things that I wish I learned when I was growing up was that financial literacy, right? I think going into college in the 90s, there wasn't anything. I learned by getting my first credit card and realizing the APR was so incredibly high. Girls Inc. is doing a lot around financial literacy. Obviously, JP Morgan Chase is a big partner in that. Can you talk a little bit about the financial literacy programs? Because that's part and parcel to all of college. Not only that, but the professional development and understanding how to be financially free.
Exactly, Kate. we have a really great financial literacy story. I think there, our mantra at Girls League is there can be no equality without financial literacy. It goes hand in hand with independence. Okay, so the panel's about insights. My biggest insight came, I think Penny said it right at the last panel. The way women are socialized, all the studies show women are less financially literate than men. But when you really see girls in action in high school, you know that it's all about socialization. We're not expected to know it. We're not taught that we can know it. There are no role models, very few women in finance at the top. Karen was saying, a lot of women in finance, when you get to the top, the air is rarefied, very few women. So we had a program funded by Volatile that gave our affiliate Girls in New York City $50,000. Now, this is a true story. I saw it with my own eyes. And we coached them. We said, things like Warren Buffett said, don't invest. It was all equities, no fixed income. Invest in things you know something about. Don't invest in anything you don't know anything about, kind of thing. Just coaching. They made their own decisions. At the end of 1 year, they had a 54% rate of return. And that's a true story. Find out what they invested in. So, but once you unpacked it, you could see there was a lack of fear. We expected them to succeed, and we really invested in them. Now, fast forward, I've been looking for funding to replicate that program, and I am very happy to say that we have been awarded the Google Impact Challenge. There's $1 million award from Google. Where's Lily? She hates me to say we got $1 million because nobody else will give it to us. But it's for software development. We are developing and soon piloting an app that is called Her Future. And, hopefully everybody in this room, I know Joyce and Kate will be very vitally involved in distributing it. That is going to demystify financial decisions and make it fun and engaging and link it to a teacher-led program that has vignettes, multicultural avatars, little stories to engage them, and we're really hoping for a very broad distribution.
Amazing. Joyce, I'm going to turn to you because you've been involved with Girls Inc. for a very long time. And you've also been involved in the college shower. And so for those of you that have walked around the space, there are lots of signs around. The college shower is one of the most impactful things that I've ever seen, and am now involved in through Luminary and obviously being on the board. Can you talk a little bit about the college shower?
Yeah, no, and so first of all, I just want to say congratulations to Pam and to Lily just for what they've done. And at Morgan, I can also talk a little bit about just the way that we have worked with Girls Inc. because we've hosted what we call the Money Talks Family Financial Literacy Workshop in our branches on the weekends. And that's the great thing about reaching girls at this age is they come in with their mother. We change the household dynamic. And so we've done things like really try to help them with financial planning, savings jars, financial planning journals. Our private bankers are sort of their private bankers, the younger women who really wanted to make a difference and do something, even though they were working like crazy hours, who could find some time to do this. And and so occasionally we will have a father come in, but these are girls who, for the most part, they're raised in single parent, by their mother, a single parent, $30,000 a year. So you can make a real difference to them. But one of the great things about Girls Inc. is not just the Voya program of investing, but their college readiness program and the national scholars that they pick who do go to the top universities. And one thing that they do, the college shower, is that they give every girl who is really the first in her family to, oftentimes finish high school, much less go to college. They give them a computer, and just like in many of these communities, having a baby shower is a big deal. Where these girls get pregnant in high school, they have a baby shower, they want a party. So the whole idea is that we give them a college shower with everything they need for college. And so there's a way that you can be part of this. This is the scan code, and online also that I think it's showing online where you can donate to the college shower, and no amount is too small. I mean, you can donate for sheets, notebooks. I mean, it is comforters, things that girls need when they go to college to accompany the computer that they're given. But it is the kind of things where it changes whole families and whole lives and the next generation. So there's a way to contribute to this. And it's just a very special organization. It's run by people who are just so committed to this cause. And it does reach households that wouldn't be reached otherwise. So I hope that you all will consider making a donation and the amount that you can. Because no amount is too small for the college shower for these national scholars. And the year that I was honored at the Girls Inc. Gala, my national scholar introduces whoever's honored, but she went on to become a teacher and an educator and the first person in her family to go to college. And I've still kept up with her even many, many years later. So I hope you all will consider this. Yeah, Anna, go ahead.
Well, I was just gonna say, I mean, what Joyce and Kate have done for Girls Inc. is, I mean, they move mountains. JP Morgan's been wonderful. Kate and Luminary have been fundamental to all that we've done since she opened. So I thank you, Joyce. And I just want to say that since Lily came, Lily, where are you? She's in the back. We now.
Yeah, Lily, come up.
Come here, Lily.
Yeah, Lily, come up,
We
please.
now have the college shower in conjunction with our gala. So it's a really huge event. It's a fun event. You get to see all the college graduates, and I want you to say the rest.
Sure. I mean, the gala is really not just a gala. It's one of those events where you go and there's just not a dry eye in the house because of the power of the young women that you see in the room. They go up on stage, they announce where they're going off to college, and we shower them, as in a baby shower or a bridal shower, but we shower them with scholarships and gifts. And it's just the most inspirational thing. And we hope you all will join us because it's really part of a larger movement to continue to follow these young women into the workplace and to get them into positions of leadership and influence, which is what we're all about. So thanks.
Thank you, Lily. And I just want to say, anybody who wants to be involved, Lily or I will be receptive, be for corporate engagement, employee panels, whatever.
Yeah, no, I mean, Pam is ubiquitous, so she will follow up with you.
I can promise you that. So Pam, thank you, Lily, thank you, Joyce, thank you. This is the next generation of leaders, right? These girls are the next generation of leaders. We don't want them to walk into rooms anymore that aren't full of women and different faces and different genders and different cultures. So this is the next generation. So thank you. I'm gonna hand it over to Mark and Ralph, I believe, our men as allies here.
And a huge shout out to our men as allies.
Absolutely.
Thank you. Did everyone notice the name of the bar here when you're walking up? The glass ceiling. At a women's event, we didn't plan that. I mean, we treated it as ironic and an inside joke. Mark and I are humbled, honored to be here. First, Yazoo, we call it Wi-Fi, women in fixing. First Wi-Fi was held at Kidney Dance downtown. Kidney does a lot of stuff for women. I was on the board. Gina gave us the space really cheap. 80 people signed up. I think 50 people showed up because of the rain. And now look at this. The room is full, overflowing, hundreds of people on Zoom. I have nothing to do with Wi-Fi anymore. It's all, this is all women running. I have to give a shout out to Joyce, Aaron Lyons, Monica Aguilar, Laura Nauser, everybody, if we need us, everyone else. If you like the Yazoo, we have several meetings. We have, a couple weeks ago, we had the president of the New York Fed, John Williams. Next month, we're going to have Bloomberg Intelligence. They're going to give us clues and hints on how to use their service. The month after that, we have our annual ESG conference. It's as big as this conference. And Mark's going to talk about the Hall of Fame later. So I am personally, I'm retiring from arranging all of the Piazzi meetings. So hopefully my successor is in this room. How are you? I would join Piazzi if you haven't already, or volunteer. It's been really, really rewarding, and can't imagine not having done it. So, Mark?
Great, thank you, Ralph. Well said. Ralph and I are both past presidents, so that's really why we're fortunate to be up here and fortunate to be part of this. But as he said, it's all about the people who pulled this together. Joyce has been a driving force, and Monica as president, she has an incredible force, not just for this event, but for all the things that we've been doing the last couple of years. And Erin has stepped up in a variety of ways, even though she's got 3 jobs and 8 kids, and travels around the world. So we're thrilled. But I think it was a great event. The content was outstanding. The dialogue exchange was really rich and insightful. I took a bunch of notes. In fact, I'm going to write them all up tonight or tomorrow. But I did want to say a couple of things about allyship because it's really important to me. I'm talking to a lot of my colleagues, my friends, my family about it. And so I wanted to share a couple thoughts about that. First, I wanted to highlight the contributions of the sponsors of tonight's event, because without their support, this wouldn't have happened. And I think sometimes we take for granted when somebody sponsors something. I'm gonna take my glasses off because I can't read with them on. But Fitch, JP Morgan, Morningstar, DBRS, Credit Sites, S&P Global, and my firm, BNP Paribas, all stood up and decided this was an important event to sponsor. And each of these firms chose to make an affirmative statement about the importance of their female clients, employees, and finance. So if it is important to you, feel free to reach out to those firms and tell them that you agree, that you appreciate that they did that. And consider encouraging your own organizations to do the same next year, because we'd love to have some new faces and new firms supporting women in fixed income. As many of you know, as Ralph just said, this event is one of 3 pillars of the Fixed Income Analyst Society. Our Sustainable Finance event on April 12th is the next big event, and we'd love to have some sponsors for that if your organizations are interested in that area of finance. And then we have our Hall of Fame event, which is something we've run for many, many years. Joyce being a prominent Hall of Fame member. And I mentioned to Joyce that when you were inaugurated into the Hall of Fame, that was the first time I learned about Girls Inc. I've been following Girls Inc. ever since. Tremendous accomplishments, tremendous growth. So you should be really proud about that. But you flagged that a number of years ago, and many people have learned from your leadership there. So April 20th is the ESG event. In September, we've got 4 fantastic members going to be added to the Hall of Fame. We hope to get a press release out next week about that. One of those 4 people is someone who spoke at this event last year. So I'm going to leave it as a surprise, but maybe one of this year's speakers will be at next year's Hall of Fame. But it's a wonderful thing. So a couple words on allyship. Why is allyship important? Why do I get involved? Why do I feel passionate about it? Number one, I've been a direct beneficiary of allyship in my 20s, in my 30s, in my 40s, and yes, in my 50s. And so it's just a natural, as I've thought about my career and the opportunities and the good fortune I've had, I reflect on the allies that have supported me. And one of my biggest allies was a woman, but some have been men as well. So that's a big reason. Number two, there are many ways to be an ally. That makes it fun. And that makes it engaging and different. So if you think about it a little bit, sure, you can be an ally to subordinates, you can be an ally to peers, you can even be an ally to your boss, which I've done on a couple of occasions with surprisingly positive impact. And then of course, there's allyship around gender, around sexual orientation, around race, around disability, around age. I've recently become a mentor to a former soldier who left military service, went into business, was a little awkward and uncomfortable with what he was doing there, but it's been very satisfying to help talk him through some situations, but more importantly, introduce him to my network and areas that can help him. So allyship comes in many shapes and forms and sizes. Importantly, it's good for business. It's good for your career. Being an ally creates all sorts of opportunities and exposures that you may not understand or appreciate. So in 2023, I'm making it a priority to encourage my friends, my professional network, and others to consider allyship, to think strategically about it, not just be passive about it. And consider being a personal or a professional ally to whomever might benefit from that. Recognize someone who's been an ally, and encourage others to give it a try. So those are my thoughts on allyship. We're thrilled to have everyone here tonight. I hope you will reflect on some of that, and more importantly, will join us for a drink and some networking afterwards. So thank you, everyone, and thanks to the program.